Hello everyone, welcome back to Desi Return. Today, we are going to dive into an important topic. What should one do with their 401k funds once they decided to move back to India? So this is a continuation to our previous video where we talked about benefits of investing in 401k and whether one should invest in 401k if they have plans to move back to India soon. This video should complement the previous and gives more insights into what are the different options you have for the 401k funds and which option would be appropriate for you. Before we dive into the different options here, I wanted to talk about a few things so that we are all on the same page and then decide which option is better for you. The first, with 401k funds, if you withdraw the funds before 59 and a half years, there is a 10% penalty unless there are certain circumstances, which we won't dive into. Second, the funds that you withdraw from a traditional 401k would fall under earned income and you have to pay taxes in US. There are different tax statuses in US, a resident and non-resident. And in the link in the description below can provide information to determine which status do you fall into. Please note, if you are not a US citizen or a green card holder and you're living in India, you would fall under a non-resident for tax purpose. Couple of things for a non-resident. So you won't be available to take advantage of standard deductions. You can't file as a married file jointly. So there are certain differences between a resident or a non-resident when you're doing a tax filing in US. So please keep that in mind. In India, there are three different statuses: non-resident, resident. The third one is resident but not ordinary resident. So this is a tax status that Indian government has provided to help NRIs moving back to India permanently for a smooth transition. This is available up to 3 years, and during the RNOR, global income is exempt from income tax in India, except the income is from a business or a profession that is controlled from India. So this is an important phase when moving back to India that could help from a tax planning. Third, estate tax. If someone passed away and there is something called an estate tax that you have to pay.
You are a US citizen. The threshold is $13 million as of 2024.
For a non-resident, it is $60,000. So this $60,000 is across all the assets that you have in US, and the estate tax could be up to 40%. So keep that in the back of your mind when you're selecting a particular option, because this is an important thing to be considered. And the last one is there has been some changes in the tax laws, especially in 2021, where in the case of a 401k or a IRA funds, the funds are taxed only at the time of withdrawal and not on the unrealized gains. This is for a traditional 401k or an IRA. However, these tax laws are not very clear for Roth IRA because the earnings on the Roth IRA are not taxed in US because this is an after-tax contribution. However, the earnings are not tax exempt in India. So if you take a conservative approach, these could be taxed in India at the time of withdrawal. So that might not be very beneficial to have the funds in a Roth IRA. So let's dive into the different options that you have when you made a decision to move back to India and what to do with your 401k funds. First one, leave the funds in your employer-sponsored plan. This could be the easiest one. There is no additional work that you have to do. However, the funds that you have in an employer-sponsored plan is very limited, and also the expense ratios could be very high. So this is not something that I would recommend. I think at least you can roll over those 401k funds into a traditional IRA funds, which is the second option, which we will dive into. So rolling over your traditional you are rolling over your 401k funds into traditional IRA funds. In this option, there is no 10% penalty that you have to pay. There is no income tax because the rolling over from a 401 to IRA is completely acceptable and it doesn't cause any tax event. However, when you have the funds in an IRA that is provided by a custodian, you have many more options to invest in. And the expense ratios are quite low. So that gives a lot more flexibility in where you can invest, and the expense ratios would be very, very less. So these custodians are like Fidelity, Vanguard, and several. So if someone have plans to move back to India, it might be a good idea to open an account with Fidelity or Vanguard because they accept a foreign address later. So it's better to open the account while you are in US. However, you can't transfer the 401k funds until you leave the job. So once you leave your employer, that's when you would have the opportunity to roll over your 401k funds into an IRA. What are the pros of this option? This gives a lot of diversification. So if you're looking to have funds diversified in US and have the funds maintained in US dollars, this could help you. And if you have plans in the future to be back in US or the kids to be back in US, this can provide some corpus fund to help out down the road. So these are the pros. In terms of the cons, keep in mind about the estate tax, especially if you're a non-resident and the estate tax limit is only 60,000. Keep that in mind. It's a complex tax filing where you have to report your assets in US in India while you're filing. So that requires working with a CPA from a tax filing purpose. But this could be an option for someone who wants a diversification or who have a different plans in a long term. Let's talk about the third option. In the third option, you want to roll over your 401k funds into a Roth IRA, not a traditional IRA. In the Roth IRA, you don't also pay the 10% penalty because you are rolling from a 401k to an IRA. However, you would pay the tax on the rollover because a Roth IRA is a after-tax contribution. So the amount that you're rolling over, you have to pay tax on that in that fiscal year. However, as we discussed earlier, the tax laws for the Roth IRA earnings are not clear in India. So it might not be the best idea if you have plans to live in India for a long time. It has the same kind of pros and cons, like the pros is diversification. And if you want to use the funds in the future, it could help from estate planning. However, the cons is the same, like 60,000 estate tax that you are applicable, complicated tax returns. And more than that, the tax law of India, like applying the taxes for the earnings is not very clear. So this is not maybe something that I would recommend if you have plans to live in India. Now let's talk about the option 4. You want to withdraw the funds while you are in RNOR phase. So you have been living abroad for quite some time. You qualify for RNOR phase. This is where you can do some tax planning if you want access to the funds and you want to you don't need the access to this corpus later in the long term, and you want to keep the tax filing simple, you can definitely withdraw these funds during an RNOR phase. And some of the pros are it's definitely keeps the tax filing simplified, and you can minimize the tax that you have to pay because there is no tax in India at the time of withdrawal. And in terms of the cons, you have to pay a 10% penalty and some income tax in US. So now let's walk through an example of withdrawing 401k funds during RNOR phase. Let's assume that you have 100,000 in your 401k and you have 2 years of RNOR phase as a tax resident, and you would be considered as a non-resident from a US tax purpose. If you have more years that you qualify for an R&R phase, you have more flexibility. And if you have only 1 year, it changes. But let's, in this example, assume that you have 2 years of R&R phase. And assume you're withdrawing 50K in each year of the 100K 401K funds that you have. So you have to pay 10% penalty on this 50K, which is equivalent to $5,000. And since you are a non-resident, you have to file as a single filer when you're filing the taxes in US. So for a single filer, based on the marginal rates, the total amount of tax that you would pay for the 50K income, assuming you don't have any additional income in US, is about $6,053. So in total, including the penalty and the taxes, it would be $11,053 for a $50,000 withdrawal. This is the taxes and penalty that you would pay in US, but you don't pay any taxes or anything in India because you're in R&R phase. And this 11,000 is equivalent to 22.1% of the overall 50,000. So you would have this money available to invest in India, and there is no tax complications that you have to manage. You don't have to worry about the estate tax. So I just want to walk you through an example to understand what is the amount that you would pay and evaluate whether this option makes sense. And also keep in mind, you don't have to take everything out of your 401k, and you can do some optimization during this R&R phase based on your needs of the funds and also the less complexity from a tax filing. And the last one is you want to withdraw the funds when you are in ROR phase, which is an resident phase, resident ordinary resident. So for some people, they might not qualify for a R&R phase because of the duration they were abroad or for different reasons, or maybe after the R&R, you're trying to withdraw the funds. In this situation, you have to pay the income tax in India also, in addition to the penalty, the income tax that you would pay in US. So if you withdraw the funds, the 10% penalty is applicable, as well as the earned income tax that you have to pay in US. And there is also like income tax that you have to pay in India. However, there is a foreign tax credit from a double taxation avoidance treaty. There's a foreign tax credit that could be applicable. But please work with the CPA to do this option. These are the different options that you have. And from my perspective, if it is at all possible, either you want to leave your funds in an IRA or you want to withdraw during an R&R phase, or in certain extent, maybe during an ROR, depending on your situation. These are the main three things that I see people want to dive into, delve into, and see which would be much more appropriate for them based on their long-term plans, based on their citizenship, immigration status, depending on their risk level, tax filing situations. In addition to all these, there is also another option called substantial periodic withdrawal. This is a very complex one. I won't be diving into this. This is something that could be beneficial for someone to take a periodic withdrawal payments from now till age of 60. There is no 10% penalty, but you have to pay the income tax when you withdraw these funds. And there are different calculations on how you do the withdrawal amount, which we won't dive into in this video. Hope this content is helpful. And if you have any feedback, please provide your feedback in the comments. And thank you very much for watching.